Hi everyone, today we'll explain short squeezes in just 3 minutes. As we know, short selling involves borrowing shares from a broker and selling them, then buying them back at a lower price if the share price falls. The shares are returned to the broker and the difference becomes the profit. In reality, however, short trades do not always work out. When the share price rises instead of falling, short sellers begin to suffer losses. Some may rush to buy back the shares to limit those losses. One person buying back shares may not make much difference. But when thousands of short sellers rush to buy at the same time, the surge in buying pushes the share price even higher. As the price rises, the remaining short sellers face greater losses and are forced to buy as well. More buying drives the price higher, and higher prices trigger even more buying, creating a chain reaction. This is known as a short squeeze. Let's look at an example. Suppose 30% of a company's tradable shares have been borrowed and sold short. This is already a very high level, indicating that many short positions have yet to be closed. The company then releases earnings that far exceed expectations, causing its share price to jump 15% in one day. Short sellers rush to buy back shares and cut their losses, sending the price from 50 to 80 in just a few days. Of that 60% increase, only the initial 15% may have been driven by improved company performance. Most of the remaining rise may have been caused by short sellers scrambling to cover their positions. How can you identify the risk of a short squeeze? Start by checking the percentage of shares sold short. A short interest above 20% should be treated with caution. Anyone holding a short position must set a stop loss rather than holding on in the hope that the price will eventually fall. For ordinary investors who do not short stocks, short squeezes can begin and end very quickly. Chasing a rapidly rising price can leave you trapped at the top, so it is usually better to wait for the price to stabilize before making a decision. To sum up, a short squeeze is a sharp price rise caused by short sellers closing their positions at the same time. When the market moves against you, cutting losses decisively is often far less costly than refusing to exit.